Hit it.
It's Friday, October 20th, 2023, episode 223. Is it 223 or 224?
All right.
God. Kevin.
Say who you are. Let's keep going.
I'm Patrick Serezna.
And I'm Kevin Muir. This week we have no guest. So for those of you who tune in only for the Outside Market Huddle wisdom, you can hit stop right now and we'll see you in a week or two. For the rest of you, we have a great show as the markets have definitely been hopping. We start with a full featured Talking Charts with Patrick, where he regales us with his voodoo technical analysis.
And then no more skin in the game. So we added a couple of interim segments. There's the new VWAP, or actually we're bringing back the VWAP segment, and we're adding a new segment called Common Sense with Kevin, which I don't know if there's any common sense there, but we then end with the No Stupid Questions, and finally we announce how to enter the draw for the dinner with Kevin after he got humiliated by my savvy betting style. And folks, we might even drink some beers along the way. So Lena, hop on. What beer am I drinking this week?
Hello. So this week, Patrick is drinking Chela de Playa Mexican Vienna Lager.
I feel like he's drunk them before. This is just...
I'm sure he has.
Yeah, it's a nice microbrewery down the street here. So I had to hop out and grab something. This is a new one. I never tried this Mexican Vienna Lager before, though, but it's actually very nice. Nice, clean, sessionable beer.
Oh, gosh.
Yeah.
Kev, give some side effects.
All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include copper drop, stop loss pop, the personal recession trading session, and the knife catch eye patch.
Okay.
All right, Patrick, it's time for a full-on talking charts. What do you got?
Well, listen, this is going to be a longer segment for us to just talk about everything, because what a crazy market and what's happening. So let's quickly go through the top three things we were watching a couple weeks ago, and then let's discuss what's coming up here. So number three was the U.S. dollar. We were just talking about whether the trend would continue, but really it's been trading sideways. It's still a pretty clear U.S. dollar bull trend, but it hasn't really taken off or done any big moves since we brought it up. And then number two, it was the start of the earnings season, and I didn't put it in the upcoming one because I just figured we'll mention it. But this is now where we get into the pig in the python moment of all the earnings releases next week, and obviously a lot of it is going to be watching the Magnificent Seven, because they've literally been the only stocks that have been holding this entire market up. It'll be really interesting to see whether or not the earnings can keep those stocks elevated. Any thoughts on how you think it'll play out?
Well, we already had one of the Mag 7s releasing their earnings,
Tesla.
And I didn't listen to the earnings call because I can't stomach it. But it sounds like he was pretty downbeat. And there's another fellow. Have you ever heard of this guy, Meet Kevin?
No.
He's this retail fellow that has a huge following. He's got an ETF, and he's been a huge Tesla bull. And he got on some show, I think it was Yahoo Finance, and he just shit all over Elon. And guess what? Elon didn't like that very much.
Wow.
He's blocked.
He's blocked.
He's blocked. But he had some interesting things to say that, he was really pushing back on terms of Elon, in terms of how he's been operating the company, and saying that he needs some leadership there. And their earnings are definitely showing us the first signs of weakness. And
you mean like every other automobile company? Like, come on, it's like it's not like they were going to be growing in a period where interest rates rise this much and consumers get tight. That's.
I know, but Patrick, you know how I feel in terms of him and the stock. So we don't need to go into it. But what was interesting was that this was a fellow that was usually previously very positive on him. And it feels a little bit like there might be an emperor has no clothes realization.
Yeah. So number one was the inflation numbers. And really, they came in a little bit above, right? But I don't think it's anything that was unexpected by the market. Everyone was sort of anticipating them to come in a little hot anyway. What did you take away?
Well, I'm not sure I agree there in terms of, you think that the people were expecting hot?
Well, not hot, but no, just that they weren't going to come in below the estimates.
Well, I think that what happened was the PPI was usually which is usually announced second, was announced first. And the PPI was hot, and then it kind of tilted the CPI, and it was hotter than expected. And I think that it really threw the market for a loop because we have a situation where CPI is going the wrong way for the Fed. And we really have this kind of push and pull, whereas on the one hand, we have financial conditions tightening and lots of reasons for the Fed to potentially pause. On the other hand, when you look at the economics numbers, you'll see things like retail sales, CPI, they're all still doing really well. So the real question is, what is the Fed watching, and what are they going to let influence them? And that's really causing a lot of problems in the market in terms of analyzing the next step for the Fed.
Right. Okay, so let's talk about the top 3 things to watch for the upcoming 2 weeks. I was originally going to put the earnings in there, but I figured we would mention it where we did right now. So I put number 3, all the global PMIs, whether the flash ones, they're all coming out. They've all been under 50. The global economies in Europe and everywhere continue to contract. But right now, it doesn't seem to be making the market overly nervous. What's your thinking here on just the way these PMIs have been coming in?
I think they're going to continue to be terrible around the world. Everywhere except the U.S. is going into a recession. And I think that it'll be obvious, and numbers like this will just show, it'll lay it out bare for everyone to see.
Yeah.
And it's going to cause real problems.
Yeah. I mean, the PMIs in Europe have been for months under 50. It's been even longer than that, I think.
Listen, the rest of the world is really struggling. America is like a shining beacon on the hill in terms of their
on
economics,
the interim,
but the rest of the world is really
all right. Well, number 2, we're going to have the jobs numbers coming out on November 3rd when the next episode is. And so obviously jobs numbers have a bit of a lag. Like by the time, at least historically, by the time the jobs numbers crack on the upside, it usually is already in the midst of a recession. And so really expecting the jobs numbers to continue doing what they've been doing for months is sort of the baseline, but it would be interesting to see if they finally crack and whether there's a jump up.
Well, I think that's a great point, Patrick, where you highlight the fact that this is a backward looking. It's probably the last one that'll roll over. Having said that, if we maybe even just a tiny little bit of uptick would get enough to get the market worried.
Well, yeah. I mean, if that number's pushing unemployment north of 4% toward 5%, that market's going to not take it well.
I still think that watch the Canadian job numbers. I think that our economy
we'll crack first.
If you're expecting the American economy to roll over, I think you should look for Canada to roll over even more quickly. So
there'll be a leading indicator.
In Canada, yes, that's how I
like it. I like it. And number 1, we in the next 2 weeks have almost every central bank releasing monetary policy statements. Obviously, the FOMC is going to be the big one on November 1st in terms of what Powell says. But all of them, Bank of Japan, Bank of England, Bank of Canada, ECB, they're all up to the podium, and they're all going to give us some commentary and press conferences. And is there one particular one that you're watching more than others? Obviously, the FOMC is pretty important.
Well, yeah, the Fed's always the one that sets the tone, but I think it's going to be a non-event in terms of it's very clear that the Fed's paused. I think that they paused not only for November, but maybe even for December, and most likely for December.
It's fun. I like it. I like it that you finally joined my camp, because I remember just an episode ago where you were talking about rate hikes every second meeting, and you know what? It's nice. It's nice that you can acknowledge that I was right and you were wrong. It's
no, but fine. I will say something, Patrick, because I think that at the last FOMC meeting, they were actually on the stance of every second meeting, and it was a very hawkish meeting.
Yeah, the problem is that you believe them.
One second. No, but okay. But what happened since then was that bonds really just shit the bed. The long end of the bed,
tightening financial conditions. Yeah,
financial conditions tightened, and after that, I guess it was the Friday before the terrible attacks in Israel. There was one of the FOMC Board of Governors got on there, and I think it was a woman. I think it was Daly, and she highlighted the fact that the financial conditions, the long end rising, was doing some of the work for them. And this was the first time we had heard them talk about financial conditions in a long time. So my antenna quickly went up. Then I watched on Monday, and Monday you had another hawk speaking. Maybe that was Daly. And she's usually very hawkish, and she mentioned the same thing. And then we had the vice chair, Jefferson, speaking, and he again did the same thing. And at that point, Patrick, I shifted, and I very quickly wrote something, and I got it out there, and I said, the Fed just paused. And there was a lot of pushback to that. A lot of folks said, no, look at the CPI number, blah, 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 or whatever. The CPI is coming. And a lot of folks were still thinking that they were hawkish. But since then, there's been lots of chances for FOMC board members to push back against that narrative, and none did. Even going into yesterday, on Thursday with Powell, many were still expecting him to leave the stance the same. And you might say, well, look at the response. The response was that actually the long end sold off. The long end sold off for a host of different reasons, but one of the kind of arguments some guys made is that he actually did pause, and that's why you had the 2-year lowering in yield, rising in price, and the yield curve steepened hard because the Fed is showing that they're no longer as worried about inflation as that they previously were.
Yeah.
So anyway, Patrick, I'm with you that I did shift, but I think I shifted because they told me to shift.
No.
And I'd rather, instead of guessing when they're going to shift, I'd rather just wait and listen to them tell me.
Yeah, you wouldn't want to do something so silly as to guess like me.
Well, the thing is, you're always betting on lower rates because the world's always ending.
No. Okay, but I wanted to just show this. This is the Fed Watch tool. And right now for that November 1st meeting, it's now fully baked that they're not moving. And even there's even a small little percentage chance of a cut. But it's like that's actually a minuscule, like 3%. That's not going to happen. But what's interesting for the December meeting, they still are giving a 21% chance that they might hike. But like for the first time, we actually are showing some sort of probabilities being assigned to a potential cut at some point.
I think that's the kind of skittishness of the stock market. Would you not agree?
Oh yeah, like I mean, what you can see. Well, I think that the bond market did it, well, not the stock market. I think the fact that everyone sees that the bond market is almost actually. Let's forget the stock market, but let's just start with the 10-year yield, and just extraordinary. Acceleration. You've seen me do this before, but I love just like looking at slope through trend lines. And what you can observe here is that the yield has actually been accelerating to the upside. Like, and this is this type of behavior, and you can obviously with bonds, you can do the reciprocal and view it as that the bond market is actually accelerating to the downside, and that typically ends with some sort of a little capitulation of some sort, and I think that is what has got everyone worried. Like, I mean,
So I have a question for you for your voodoo magic. Yeah. Some folks have talked about the TLT, and they see the enormous volume of yesterday, or maybe it was today, and they say that was the washout low. Others, I've been talking to, say, no, we're going to get a guilt-like crisis moment.
There is zero evidence that yesterday was a washout. Nah, that's nonsense.
Okay, that's what I want to know. So, like, that's not good enough?
You know what? Someone is overanalyzing. That's not a washout. That's no. It could it could get worse. You know what? I look. I have to say that, while I'm here trying to, be all cocky saying that I was saying the Fed was already paused and thing, but I'll tell you, I got the bond call wrong. I thought the lows were going to hold and bonds were maybe not going to be bullish, but this is not where the selling was going to happen. And I was dead wrong. Like the bond market is having its face ripped off. And this is what's actually causing the ripple effect. It's I didn't think we would have a 2022 deja vu, but we are, where basically everyone thought 2022 was a bear market in stocks, but it wasn't. It was a bear market in bonds. Then higher yields dragged down multiples and valuations, and stocks had to adjust, right? And we're in a scenario where, once again, this is like 2022 all over again, with bonds just tanking to the downside. And
well, I'm not sure that analogy is exactly correct.
All right, well, give me your perspective.
Well, no, I'm agreeing with you that the bonds are tanking, and I'm probably agree with you that the average stock is tanking. But where this one is different is that there's the Mag 7 is still,
I think it's a lag.
spitting
I think it's
distance
just a
from-
lag. And shit hits the fan when everyone stops drinking the magic Kool-Aid.
the magic Kool-Aid.
Yeah, exactly. Like somehow there's safety in the Mag 7. Like once everyone runs for the exit door, there's gonna be nowhere to hide. Like I'm not to make it sound like I'm bearish or anything, but well,
You bearish?
come on. But
Believe it.
I want to highlight is look at the way investment grade bonds have been selling. I mean, obviously they correlate to Treasury. They're going to be yield correlated. But what's interesting is that the junk bonds, they broke, but the junk bonds up until September have been shockingly resilient. They obviously because there wasn't that big movement in the front of the curve, because you often make that reference that duration matters on junk, and they obviously have much shorter duration and correlate. Do you usually reference more to the 2 or the 5 year? What's the average duration on junk?
Well, I think the duration on the HYG is 4.6.
Yeah, so like a 5.
So you generally trade it against kind of fives.
Against 5s, and so all the trouble's been in the long end of the curve, right? But what's interesting is that I was always saying to me that when junk bonds break, it's like the canary in the coal mine, and as far as I'm concerned, the canary's dead. There's a month for the last month. The canary is flapping in the coal mine, and it's a warning that. And I think the stock market is selling in many ways because of this.
So, Patrick, I got a confession to make. I didn't realize this, but the CBOE Futures Exchange has a high yield and investment grade futures contract.
A high yield
And listen,
investment grade.
like basically an HYG and an IG and LQD futures equivalent.
That's awesome.
So so I went and found this thing.
Is it liquid?
I was talking. Well, no, it's not. But I don't see why, if you actually were an institution and you wanted to trade it, that you couldn't get someone to EFP you the actual futures contract. But in the meantime, it's trading 50 or 100 lots a day or whatever. So I'm just like putzing around with my fives, and I'm starting to trade it, Patrick, because I want to be short the corporate credit. One of the things is when you go do that, let's say you were to go do that trade where you short HYG, you buy IEF or whatever the equivalent is, IEI, whatever the equivalent ETF is for duration. You do that, there's a huge capital required. You need to put up 35% on both sides, so it's like 70%. And the reality is that spread doesn't have it's just not worth it. It's just, it doesn't make that trade feasible. But if you do this in futures, all of a sudden you can go buy ZF or whatever it is, or FV, depending on what system you're using, basically the 5-year treasury. You can short this, and you can be short corporate credit for a decent kind of margin.
Yeah.
It's efficient. It's great. So
long as you size the trade right and you're not going to get squeezed, then there's no issues with that, right?
No, listen, you got to know what you're doing and go figure out the proper duration matching and stuff like that. But the point is, up until now, like all the big institutional traders, they trade what's called CDX swaps. So they have a very efficient way to go and actually bet on corporate credit. Like that's the thing that Bill Ackman was long when he was, playing those games during the COVID crisis. That he was trading CDX swaps, I believe. And the trouble is for non-ISDA kind of folks, it's been very difficult to find a capital efficient way to go and actually bet for or against credit. And my point is, with this CBOE futures exchange, which is different than the CBOT or the CME, it's actually it's the same firm that does the VIX futures. Right. They have a futures contract.
That's awesome.
So anyways, check it out. It's interesting.
I'm going to message you for the symbol again. All right, but listen, but I wanted to just touch on this actual credit spread. And we are obviously back above 4%, because I couldn't even believe that we were under 4% for several months. but it really looks like it could have been a trend changer. And to me, it'll be really interesting in the next week or two to see whether this works its way back to 5%, the levels we were at when the regional bank crisis was actually going on. And so obviously a turn up here, and I think it's worth watching to see whether this the credit spread continues to widen. You're obviously betting on that, right?
I am. But one of the things that I think is interesting that everyone should be aware of is they should go read Howard Marks' latest memo. And Howard Marks is the founder of Oaktree. And it's titled Further Thoughts on Sea Change. And it's dated October 11th. And in it, he argues that in essence, more and more pensions and other kind of long-term money managers are going to start looking at the yield that can be offered by corporate credit and buying their kind of corporate credit and selling their stocks.
Right.
So while I understand your argument that when you look at it, you might say to yourself, oh, the spread's too tight given where we're at in terms of the economy. When you actually look at the all-in yield that they're receiving, it really feels like to them, it's all of a sudden it's great value.
Right.
So for the first time, they can get 7, 8, 9%. And if you think about those are the numbers that they've been trying to achieve on their long-term equity holding for over the long time. And equities go up and down and you're not always guaranteed it. Whereas this is more of a contractual obligation. So what I think is interesting is that, yes, you and I can bet on this credit spread widening out, but I think that there's also going to be another longer term asset shift going on that Howard Marks highlights, which is going to be buying corporate credit and selling stocks.
Yeah, at some point it's going to make sense for sure.
Well, I think that point is already here.
So I wanted to let's talk, since we're on bonds, let's keep talking this bond topic. And I wanted to start here with the 2-year yield. And I thought it was really interesting that in spite of the Fed signaling that, they've paused, you would think that the 2-year would be the place where you would see this have already reflected in that. And yet just a few days ago, we were at 5.25 on the upside.
Well, I think, but Patrick, at that point, people were still thinking the higher for longer.
2 days ago?
Even though I went and saw a week ago, I was like, oh, look, they've shifted. The pushback I was getting was huge. Everyone was telling me, no, they're going to raise rates.
Yeah. Well,
and you just go look on Twitter and go look at very prominent people were saying that no, November's in the cards because of the CPI and because of retail sales.
Right.
So that's not surprising to me at all.
Yeah. So I want to move on to looking at yield curves and basically just how this bear steepening has been kicking in. By the way, kudos to you. Like I thought the steepening was going to be a bull steepening inevitably. I didn't think that this was going to be such a clean bear steepener. And here we are, almost the entire inversion is flattened.
It's crazy, isn't it? It's a wild move. Listen, almost nobody ever believed that this could happen.
Yeah, no, I didn't believe it.
Yeah. I think someone I saw, one of the prominent kind of bond traders on Twitter saying this is the greatest bear steepening of all time.
Is it? Wow.
I don't know. That's what he said. I respect him. It's that Ed Bradford guy. I think he's a terrific follow on Twitter. And he was, I don't know if he's kidding. It was tongue in cheek or if it was true, but it's definitely been a wild bear steepening.
No, it has, and the question is that is it now going to only accelerate if at some point the Fed is forced to outright pivot and suddenly it switches from being a bear steepener to a bull steepener and then just keeps steepening and steepening from that point on? Like, do you think that that's possible, or is there's going to be a pivot like that and the steepener just keeps going?
Well, even though I think the Fed paused, I think that's a lot different than
pivot, of course,
cutting.
Of course.
Yeah.
I mean, the average
think
period that the Fed remains unchanged is sometimes as much as 8 months. I think it's 8 months average. So
yeah, and they've told you that this might be longer.
Yeah.
And my point has always been right now, like lately, I've been saying that the Fed had two ways of tightening. They could tighten by higher, but they could also tighten by longer,
Yeah.
meaning like they hold this level for longer. And this week, I think what happened was they shifted from higher to longer. And that's where we're at. Now the real problem occurs, like as we sit here, is this too tight? And if so, does that cause the stock market and financial conditions to continue to tighten?
But historically, that's what always has happened. They tighten until they break something, and then they have to cut. And the thing is that I mean, it doesn't have to be. It doesn't guarantee it's going to play out that way. But there's a long history of a precedent that that's often the way these things end. And
you know what I think is funny is, Patrick, is that all those recession bro folks, you know, like the
Like
ones
me?
that were lecturing us, like we, or it'd be like, recession bro, you don't get it. The bond market was inverted. You don't get it. You don't get it. And now a lot of them are actually giving up on the recession call when it's more likely today than it was 6 months
Yeah.
ago. Right? This giving up on the recession and having rates go up at the long end, it almost was needed to cause the recession.
I always had a problem with the recession calls because in my mind, I always like look at it that often you would have years of tightening of conditions before the recession finally kicks in. And everyone, as soon as the Fed started raising, was so sure that the recession was imminent. And it's like they could have been years early. That's the way it's is in some degree or another proving to play out. And so they're
You've
exhausted.
been very consistent with that. I completely agree, Patrick. Lots of times on this show, you've been sitting here saying, no, it takes a while. You know, monetary policy acts with long and variable lags. And you're saying that this is not that unusual.
No, like I still think that Darius Dale's call of a first quarter of next year has a real good chance of being where we suddenly see like jobs numbers spike or something. But you know, we'll see whether or not. Sometimes the stock market dropping creates a psychological, you know, sting on consumers that tightens the purse and kind of triggers something. And that's why I think watching what happens here in the stock market is so important. Like, let's talk about this S&P. Now, the S&P 500 down 56 points on Friday, literally trading back to its September-October low. That entire pop has been given back. And this price action is shit. Like, this is incredibly weak price action. And like the rally literally only lasted a week. And it was nothing but literally a 50% retracement of the prior decline, and all of the characteristics that the bears are still in control of this. And right now, if this low doesn't hold, it measures down to 4,100, which is where those April-May lows are. But really, once that kind of a sell sequence begins, it becomes like you know, a snowball rolling down the side of a mountain.
Self-reinforcing.
Yeah, it becomes self-reinforcing. And so even though we might get a leg down, the thing is that if suddenly there isn't a big catalyst for a save, then then it's just going to be a sell all rips kind of market environment for the rest of the year. And you know, when you look at it, the S&P looks bearish, but look at the way the equal weight S&P looks. I mean, the S&P equal weight is literally about to break its March lows. Like we could find,
you know what's kids me, Patrick. I've been kind of consistently bearish and scared for a while now.
And
I think it looks ugly. I think it's terrible, and the
you know
reality is, even with the Fed pausing,
you know
I don't think that's going to see.
You know what's uglier than this equal weight S&P index? The Russell.
What? Oh yeah, it's terrible.
The Russell cracked all of its year lows. It is at a 2023 new 52 new year low. It's almost, actually no, it is almost a 52-week low, because it was in only early October of last year that it was down there. So I mean, we're pretty much trading at the bear market lows. And it's just a very ugly chart. If this gives, I mean, we're talking about a no man's land under 1,600, where this thing could go to 14 or 1,300 very easily if this support line doesn't hold. But when you look at the entire market conditions, it's just so weak. I have this chart here. This is the number of stocks on the New York Stock Exchange trading above their 50-day moving averages. We're still at 19%, which we were at just a couple weeks ago. We were down almost at 15%, but that's over 80% of stocks that are in a very distinct downtrend. The breadth of the market is just brutal. And really it's those FANG stocks that are holding this up. So, when you look at this NASDAQ, here, I'll just look at the continuous, it's trading along its August and September lows. If this area gives out, then that could mark a high. And one of the stocks that is going to be the most interesting, I'm just going to use an infamous pattern in technical analysis of the head and shoulders top. And when you are looking at this topping formation, if the neckline of NVIDIA breaks along this 420 line, where it's just or 410 line, that's a classic topping formation. And I think NVIDIA is going to be huge because it was, I would argue, the leader on the way up.
Yes,
and
sure.
So while Google's holding up and while Meta is holding up, it's the way I look at it. This is like shooting the general. If this,
I like that. That's shooting the general. It's over.
Well, I mean, then the troops scatter. Right, like
it's like killing Darth Vader.
Yeah, you don't kill Darth Vader, man. This is crazy. but it's. Now look, has NVIDIA broken the neckline? No. So is it already somehow a sure thing? No. But this is an ugly chart.
Darth Vader is not dead.
He's not dead, but he's at the edge of the cliff and losing his footing. And if he falls off the edge of that cliff, I don't know if the Force can save him.
By the way, I have to say something. You said No Man's Land, and I went and looked it up, and you're roughly the same age as me, even though I look 100 years older. Did you watch No Man's Land with Charlie Sheen when you were a kid?
Yeah, but I totally forgot all the...
Remember when they steal all those Porsches? It's like a ring of car...
No, I don't remember that.
Steal Porsches? No. You don't? And there was the slant nose 911. That was the Porsche you wanted. Like, it was the slant nose. But anyways, I was just looking it up because I wanted to make sure I'd gotten it right. No Man's Land. And an amazing stat. Dick Wolf, like Law and Order guy, wrote that and directed that.
Awesome.
I know you care.
I do, but
I should talk to Lee.
Yeah,
okay, go on with your market wisdom here.
The VIX, it's above 20.
God, at least you're not doing technical analysis.
Yeah, no. It's above its moving average, Kev. That we've been like, I just at the start of September, I couldn't believe that we were on a 13 handle on the VIX, and obviously it was an incredibly narrow traded summer with almost no volumes. Everything was calm, and the realized volatility was really low. But to me, it was insane that we were down there. I viewed that like when with members, we were loading up on long-dated put options back in on September. Like we were buying these like 1 year plus. We were getting down 20 vol on 1 year volatility on the.
Well done.
It's
good purchase.
But you know what the point is that volatility was so cheap, but now it's getting more expensive. Now we haven't seen spikes above 25. It's above 25 is when I kind of view it as the market's panicking a bit. And like, so this is kind of, it's going up. It's realizing the daily ranges are 50 to 70 point day ranges. It's got to now price higher realized vol. But I think it's going to be really interesting with all of these markets trading at the edge of a cliff, like along these major support lines, all the September lows and things like this. If we come in Monday or sometime early next week with let's say an earnings disappoint that just knocks the feet out from underneath the markets, that could be enough to spike the VIX up over 25, and then we get something rolling. It's definitely a thing to watch.
So you know what's interesting, Patrick? If you notice that the move or whatever you want to do, take the TLT implied vol. Like the long end of the bond market is actually more volatile than the stock market.
Yeah, that was insane.
And when you look at realized vol, So I was actually thinking that just for shits and giggles, like, because this is a scary trade, but I'm so tempted to sell like TLT straddles, delta hedge them, and buy SPY or SPX straddle.
Right.
Because I really think that the move, the volatility in the bond market, if it continues, it's gonna translate into the stock market.
Yeah.
And I think that that's really been this. You said that you're surprised that the VIX was so low. I'm not surprised the VIX was so low. I'm surprised the VIX was so low while the move was going up so much.
That was actually an insane part. Was that bond volatility never contracted the same way? I was actually quite surprised by that. Actually, I'm pretty sure Harley was pointing that out as well during some.
Harley's a genius. Look at this PFIX thing that he made.
Unbelievable.
$111.
No, like
hats off to Harley.
Yeah.
Well done, bud. Like really great trade. Well, well executed. Great, theory and stuff like that. That's been a
great
home run trade.
Great product. I have some.
Sorry about that we just gave you. Congratulations on the air because this thing's going.
I've had it inside a published portfolio as a hedge to bonds, and so while there was an allocation to the long bonds, that PFIX has been like saving the frickin' bond component. It's been a fantastic way to hedge it out. Anyway, let's talk about some of these global equity. Nikkei has been generally one of the stronger equity markets, but it really finally seems to be succumbing to the pressure of global equity, like in the correlation of everything. Like it's still obviously, I would argue, the strongest on a relative strength basis, but this is still a very weak chart. And I don't think the Nikkei is going to be able to decouple. And so if the market here continues down, I think the Nikkei is going to, it'll still do on a relative basis probably better, but it does look like it's poised to still weaken here.
Yeah, listen, it could go lower, sure. I think though it's buy a dip or buy it on a relative basis.
I'm with you.
It's still the strongest market
same with India. We'll talk about that in a second.
Yeah, I'm not as sure about that one anymore. Yeah. But anyways,
but look at how weak the Euro stock is. And what I found insane about the Euro stock was it was the strongest out of the gate in 2022 in October. Like that move from 3,300 to 4,000 just came like within a month. It just ripped, and it's been losing momentum ever since. And after putting in what was basically a 4 or 5 month topping formation, it's finally cracked. And if it gets out 4,000 here, which is where that March low is, we could find ourselves deeply reverting back down towards probably 3,700 or lower. I would be very cautious about the European markets here.
I don't disagree. It's a bad looking chart.
Emerging markets, typically, this is the EM. Typically, they do poorly when there's strong dollar. I don't see this being any different than all the other equity markets at this stage. What's interesting, the Canadian market also, after spending the entire year in a very distinct sideways trade range, it's bearishly broken. And it's interesting because obviously the Canadian market is overweight energy, but it's also got those awful Canadian banks right now. And so it's like a mixed bag. I don't know whether, it's worth shorting the Canadian market. I would probably focus more on shorting the Canadian banks as a basket versus doing the whole TSX 60. Do you agree with that?
Oh, gosh, you took my crayons with Kev.
Okay, let's move on. So,
we'll talk about it when it comes to.
So the Sensex, obviously, India's been holding up really well. And in fact, it looked pretty bullish right up until the start of October, and really, again, a failed rally, trading right back down towards neckline. I think a drop down to 63,000 is on the table here. What I wanted though to move on though is look at just the breakdown in China. The China China A50 has been awful. It's been all year a systematic sell-off, every rally failing, just nonstop distribution over and over again. I don't know how this doesn't do a direct retest of that October-November low, and probably even in the next week or two. It's just an accelerated breakdown here in China. And to be honest, I wouldn't even be shocked if it's trading below 11,000 by November.
Well, some bearish.
I wish I had something more bullish to say about that. Well, we get to commodities. There's more bullish things to say. Like even look at the Aussie market. Has struggled all year along major highs. Now with the sequence of lower highs, lower lows, the breakdown back down to March lows is here. Like it's just ugly out there, Kev. Like the at least on the equity side, it's very hard to find any global equity market that is a place to hide right now. I mean, like I said, on a relative strength basis, I would argue that you can, that you'll be better off in Japan than other equity places. But I still think this is a period where, owning short-term treasury paper yielding you 5% is better trade than equity on the short term.
Yeah, could very well be, Patrick.
All right, let's talk some commodities, bud. Let's start with crude oil. Okay, so I hate when geopolitics comes into play. We were trading before this whole escalation in the Middle East up at $94, $95 on crude. And yet everyone on Twitter right now is there's a few people on Twitter out there that are now saying that the $7 war premium is in, like the pop from 85, the pop from 82 to 88 was somehow them pricing in escalation when we were trading at a higher level a month ago. I just don't think there's any war premium being priced in here. And I don't even know whether war premium should be priced in. I don't know whether or not there is as much geopolitical risk. It's certainly whenever the Middle East, escalation occurs, obviously the first thing that comes to mind in anyone is oil shortages and supply disruptions and things like this. But overall, this has been a still relatively bullish price action. To me, it's really important that if oil is going to stay bullish, it's got to clear 90 in the next in the next week or two. If we can't get above 90, then it means that we're in some sort of a consolidation and the bullish phase may be pushed forward. I just don't see a scenario where oil's under $80 unless we're already in a recession, because that's probably the only scenario where I think we have a short-term collapse in oil demand is if the whole world basically goes into some sort of recession that causes oil demand to fall off a cliff. I don't know. What's your take on this?
Well, I'm going to take the other side of your trade when you said you don't think there's any war premium in there. There's some. Whether it's $7 or not, we can debate. I probably wouldn't. I would agree.
Okay,
with
what's different?
$7.
What's different about the oil markets today than when it was trading at $90 in September?
No, but all the fundamentals are always shifting. So the question is, you have to ask is, based upon what's happened, have new entrants either bought or sold, depending on that information about the potential of a war? Has that been incorporated into the price? So you don't know. You're saying, well, nothing is still $90.
Look,
it was $90.
You want a war premium? If it was at $100, I would drink your Kool-Aid.
No, but Patrick, absent this war, this thing might be $80. You don't really know the right price of this.
Fair enough.
Like you don't. So I'll take the other side of that. I look at it and go, how many people went out and bought oil because of this? Like how many people changed their portfolio mix and how many, producers went and, covered some of their hedges or yada, yada, yada. And I go, there's got to be some. There's just no way there's none. Whether it's $7 or not, I don't know. I'll leave it to smarter guys and gals to tell me that. But I definitely think there's some. Like tomorrow, Patrick, if we had a situation where all of a sudden everything was in the Mideast was fine. Like it's not going to happen, but let's just imagine it did. Under your argument, oil wouldn't move.
I still think oil can go to 100 irrespective of whether or not.
No, I understand. But you're saying nothing would change. And the guys that are saying that there's a $7 war premium would say that $7 would very quickly come out. So I would say I don't know if $7 would come out, but I'm pretty sure that it wouldn't not move. I think you'd have
but I mean that's just like someone moving the stock market 30 S&P points on an inflation print, and then the market rebounds later. Like it's of course there's going to be traders responding, but is there a fundamentally different lower price that oil should be, that the fair value price of oil is if the Middle East situation was not heightened the way it is? I personally think oil can still be at 100 plus irrespective of if there was. Anyway.
Oh, but you're not. Those are two different statements.
Okay. Yeah.
Okay. Anyways,
all right.
go on.
So actually, before I get to the rest of the commodities, I forgot to talk about currencies. I want to just touch on the dollar here for a moment, and I'm actually we were overdue for the U.S. dollar to pause. And it's a very typical, after a bullish extended move, for the markets to backfill, retracements, returning back to moving averages, fib zones, whatever. Like there's always a pause. But overall, the dollar still looks uber bullish for at some point a trigger for a continuation pattern. And you just look at the currency pairings. The euro still so weak. The pound sterling trading pretty much right down to multi-month lows. The U.S. dollar yen tapping at that 150, just toying with the Bank of Japan for some intervention. You have the U.S. dollar against the renminbi trading right up into the high. The U.S. dollar CAD ready to go for 139, 140. You have the Aussie dollar trading right along the lows, ready to break. It's brutal out there. There is no way you can make an argument that the conditions are there. Maybe that in itself could be the only argument to make, is that things look so bad that it get worse. It's
so bad it's good.
But who knows? I still think that these the dollar, it still feels like the dollar's ready for another move, bud.
I don't know. I don't have a view. I'm gonna
on balance. I think the trend is your friend, and I would not be shocked if we're 108 to 110 on a rip during a risk off cycle.
I have no friends.
Okay, so
it's definitely not the trend.
So let's talk about gold and this extraordinary run. Like what a reversal. Like it was so bearish 2 weeks ago. The breakdown, the breaking of trends, the price action was weak, and suddenly everyone decided that it was time. And whenever you have a rip in a price of anything, it doesn't have to be gold, any chart that wipes out the entire last sell cycle in one fluid motion like this, it often marks trend reversal. And while I like buying dips, not rips, so I'd rather wait for this to pause to put position. But this is probably the most bullish price action that we've seen since that November and March moves on the upside when gold was breaking out. Like this could set in motion a clearing of 2,000 in the coming month, and that puts 2,300 in play, all-time highs. It's like I said, I'm not buying the rip. I'm going to wait for little dips. That's the way I prefer to enter. But this is the first bullish price action we've seen in a long time.
I don't want to.
Okay, then don't say anything. Okay, so let's move on because you don't want to go trade. Okay, so the other thing that I find interesting is just how severe of a drop gasoline futures had. And the one part that does put the short-term oil trade into question is whether or not gasoline can play ball. I find it hard to believe that gasoline will be struggling and oil will be ripping. I think the two are going to correlate, and so I think the really interesting thing to watch next week is whether or not gasoline can also recover north of 240, 245 a gallon and really start heading right back to its 52-week highs, because that would be what the condition where oil's clearing 90 and we have upside momentum building. And so watching what happens here, I think, is critical. Any comment on that?
Nope.
Next thing, nat gas. I actually thought that breakout had a chance. Look how it gave it all back. This is the December contract, but nat gas is
it just loves to just tease you, get you all excited, and then just like boom,
boom, just
you're going home.
And
it's just terrible. Like it's like every time you think.
And this is we're talking winter gas, right? Like if you even if you let's say look at the January, which is trading like 20 cents higher, 25 cents higher than this December contract, it's still massively below the from a seasonality perspective where future winter gas contracts years forward are trading. I mean, is the abundance of supply that huge, or is the season going to be that warm that like these prices are trading like this? I don't know the full.
There's just a lot of gas. Like it's just unfortunately, don't forget as well, gas is a local thing.
Yeah, it's regional.
So, like we go and look at European gas, it looks a lot different than this.
Mm-hmm.
And sometimes, gas is even a byproduct of when they're drilling, and like, so it's kind of like silver.
Yeah.
Like they drill for copper and they find silver or whatever. I got nothing to say except that it's a heartbreaker.
Look how bearish.
You tell me when you give up and you don't care about it, and you start telling me it's always going to go down so I can get extra long.
You know what? I remember this one guy we had on the show that was making fun of me for calling Dr. Copper Dr. Copper. And I don't know who he was.
Shit, who is that guy?
I don't know.
You shouldn't get him.
No,
on
we
the
should
show
not. Because Dr. Copper's been bang on. And
God damn it. It's such a stupid thing to say, though. Like, it's really, he's got a PhD in economics. Screw you. Like, it's like, everything.
And yet Dr. Copper has done me no wrong. So the
well, that's not true, because the U.S. economy has actually been super strong.
Oh, super strong. That's what you want to call that, right?
No, well, if you go look at GDP now,
but copper is also reflective of the Chinese economy and all these other global.
But I thought it was a PhD in American economics. I didn't know this was. We're going to now couch it, and it's a global thing.
Global economic slowdown, dude. Get with the program.
I just find that. I think it's the dumbest line ever. I saw this piece the other day about how Gunlack loves his copper versus gold ratio versus bond yields.
Okay.
There's like this thing, and it's just completely gone, like, cross-eyed. Like it's just the whole dual axis chart has stopped working. It's funny how you don't mention that anymore. Like it's just a lot of these things that when you say that this has got to equal this and stuff like that, yeah, it's fun to look at and stuff like that, but it's not really indicative of anything except the price of copper. And if all of a sudden, we get more copper, the economy could be doing great. And it's just that we found more copper. Yeah. So it's not a PhD in economics. It's just, a lot of times I hear why people use it, because on the whole, when the economy is doing better, we're using more copper and therefore it goes up. But I just think that if you grab hold of those narratives too much and use them too often, like it's almost like the time where you grab hold the most is when it's not going to work.
So three and a quarter
copper. I
love 3.25
copper just rip in your face and have
3.25
plunge. It's
going to 3.25.
Okay, well is that based upon the global economy outlook?
No, that's my crayon line. Okay. Uranium still ripping. It looks like Cuppy's got a smile on his face.
Yeah.
It's
I gotta listen to it all the time, every tick. We love you, Cuppy. I'm just kidding.
Every tick.
It's just, when you get in a group chat with some uranium bulls, and like it's like, oh God, like I get play-by-plays on every bid and offer on the uranium.
That's hilarious. All right, Kev. Is there any last things you wanted to touch on?
No, we got to do Krayons with Kev.
All right.
I got my stock.
What?
ZEB in Toronto.
Okay, so let's pull this up.
It is the Canadian Equal Weight Bank Index. Try not to let my fundamental bias affect it too much, but I can't help myself. Can you zoom out? Yes.
Yeah, I'll put on a weekly chart for you.
Even more. Let's go back. All right. This thing has been bumping along $32 support. It's 1, 2, 3, 4, 5. There's no such thing as quintuple bottoms. It's finally broken down. It came back up. It tried to, tease you that it's coming back up. It's now starting to go on the downside. I look at this and I think it's headed to at least the bottom of the range that we saw in 2018 or those periods, down to $23. I think you short this with a stop that the 32 overhead support turns into resistance on the way back up, and it holds.
You got to go a little higher than 32, but that 33 to 34 range kind of zone. But
okay, you don't want to get stopped out on like one day or whatever.
I think that $26 to $28 target below is certainly realistic. That's that fair value zone that from 2018 and 19 that it traded there. Yeah, that would be a realistic target zone for it. But the one thing here is like if this is just an orderly sell-off, that would be definitely a good target zone for a trader looking for the market to react and bounce, because often bear markets, like even if this thing is destined to go back down to $18, that's 2020 lows, it ain't going to do that in a straight line, or at least it often doesn't. And so I think
this thing could grind lower, and I think it was showing you, it kept bouncing along that support. Kept, hitting it, and I feel like this.
You know what? I'm going to give you your honorary box of crayons. You're doing all right.
Nice, thanks, Dad.
All right, Kev. It's time for VWAP, videos we analyze and pull apart. What are you going to share with us, bud?
Okay, so we're going to try to do some that are a little more fitting for my technically sophisticated friend. I'm going to do stuff instead of doing some economics. We'll do some kind of more trading and with a little bit of psychology and stuff. And we're going to start with one. And I'm just trying to find the name of this guy. I think it's Walter Redeemer. I'm sorry, I should be more ready. He's got this line. It says, "When it's time to buy, you won't want to."
Yeah, there's a book written that way.
You ever heard that? Yeah. Well, that's his book. Okay. You won't want to. So let me just get his name properly here. Walter Deemer. Okay. And so I have two different episodes here, or segments with him. Let's start with the first one here. I thought it was very interesting.
But at the moment, the FANG stocks seem to be everybody's favorite. And they are unquestionably the greatest companies in the world, the very finest companies in the world. The question is, how much do you pay for? There's a limit. I don't know what the limit is, but there is a limit. It is not infinite. You don't pay an infinitely high price to buy the Apple Corporation. I don't know what the limit is. And one of the charts, my favorite chart of all time, is in every one of my book, which is the McDonald's Corporation in the 70s, which at that point we had the Nifty 50.
So, Patrick, first of all, what I like about this is you don't get many guys talking about actually trading the Nifty 50.
Mm-hmm.
Right? Like
those were the good old days.
Like everyone, the good old days. Like
but back then the charts you needed to draw them yourself with a pencil on a. Seriously, there was like computer charting was not.
No,
there.
I know there was. Yeah, you're absolutely right. But I really like this discussion because it was nice to hear from somebody who actually traded during this time.
A very interesting time, by the way, because the only stocks that were going up were high-quality growth stocks. Everything else was going down. So if you look at the chart of the advanced decline line or the value line index or anything like that, they were going down. The only stocks that were going up were the 50 high-quality, big-cap growth stocks.
Isn't that fascinating? Because, like, I kind of knew it, but I guess I didn't realize how similar it was.
Yeah.
Because that's what we feel like now, right? We're sitting here watching the S&P equal weight, or we're watching.
But the interesting thing, though, is this little move in the Magnificent Seven really can be summed up in a 6 to 9 month window. Like the Nifty 50 were ripping like that for years, was it not? Like this was
yeah, I think it was longer. It was longer.
So, like, right. I think that the Magnificent Seven were so ridiculously oversold back in October that they rebounded first, and then it became the hot thing for them to chase, and it kind of created the animal spirits that drove that.
I might argue, though, that the one thing that like we haven't changed as people, like people are still people, but technology has sped everything up. So I've always talked about my series of rolling bubbles. I think that your point to saying that the Nifty 50 was longer, it probably was, but it probably took longer for that information to spread and for the
because everyone was waiting for the morning newspaper to find out what happened the previous day.
That's right. Right.
Which distorted the average. Any similarity between today and then is, of course, purely coincidental. But it got to the point where it's a stretch. So McDonald's in early 1973 is selling at 75 times earnings. Well, in the next 8 years, their earnings compounded at 25% per year for 8 years. Never missed a quarter and everything, and the stock was cut in half. So in 1973, if you had said McDonald's is one of the greatest companies of all time, its earnings are going to grow at 25% per year over the next 8 years, even at 75 times earnings, it's probably going to be work out all right. Well, guess what? It did. The stock got cut in half. And by the way, Putnam was a big quality growth stock buyer, so we bought it at 75 times earnings. When it finally bottomed in 1980, it was selling at 8 times earnings, and we were selling it. Psychology.
So I think I've made this point before about Cisco. Like I've gone and looked at Cisco in 2000 and looked at what it was trading for, and then seen what the actual earnings did in the coming years. And it was the same deal.
Mm-hmm.
Like the earnings actually grew. It was great. It was fine. But they
the
just
multiple
didn't grow fast enough.
Well, then that's the argument people are making about NVIDIA today. It's not that NVIDIA isn't going to keep growing and it's not going to be a market leader. It's just what was the sales multiple it was trading at its peak?
35, I think.
35 times sales. Like there's a point where even the best case scenarios could not save the fact that you're overpaying.
Yeah. And I think that it's just interesting to see how in history we've done this before. We did it in the Nifty 50, we did it in the .com, and I think we've just done it with the Mag 7 too.
Yeah.
All right, so let's go to the next one with him. This is where he's talking about the origin of that line. When the time comes to buy, you won't want to.
Because back in the day, that actually happened back at Putnam. I was running the market analysis department, and I was trying to get people away from the short term. But I was bullish, but I thought the market was going to have a correction. Fortunately for my career, it did. So the market goes down, and the fund managers come in my office and they said, "Is it time to buy yet?" And I said, "No." Next day, the market goes down some more, and the fund managers come into my office and say, "Is it time to buy yet?" And I said, "No." And that happened for a while. And finally, to get rid of them, I looked them in the eye and I said, "When the time comes to buy, you won't want to."
How good is that? Yeah. And it's so true. Mm-hmm. And it's so true. I'm going to tell you an example of that. Well, let's listen to the rest of this thing here.
Because by the time you get a bottom, go back to March of 2020, when the market finally bottomed, they're going down more than 30%. The day of the bottom, did you want to buy? The headlines were bleak. We were on lockdown. COVID was killing everybody. We're all going to die. The thing is, things are always rosiest at the top, and things are always bleakest at the bottom.
Do you remember that, Patrick? I got on that show where you cheated on me with, and I think you were bullish. I was bullish. I said some stuff, and holy shit, did I get some hate mail? Like I got just the trolls from the Doom at 11 trolls were just vicious. Told me I didn't know what I was talking about. There was no way that stock markets were going to go up, and I think it's unfortunately just part of trading that you have to live with that. Jim Grant always says the key to a good investment is have everyone agree with you later. Right. And I think it's so true, right? Like the reality is that those times to buy are when it's so tough.
Kev,
when no one wants
but if
to.
you think about it, if to actually buy at the absolute very best price you have to be buying when everyone else is trying to sell. It's just flows. There's no way the price of that security would be trading that low if everyone else agreed with you, right? Yeah.
By the way, have you ever heard the Harley Bassman line? I'm sorry to interrupt, but have you ever heard the Harley Bassman line where he says, "I've never bought the bottom except one time when I went to sell and I hit the buy button by accident." It's like such a good line. It's so good. Harley's just awesome. Like, it's like, that's such a good line. But that's the thing. It is like being a trader and doing these things. It's lonely, and if everyone agreed with you, it wouldn't be a good trade.
You know what? The one thing that's I'm trying to paraphrase someone. I'm trying to remember who said it, but maybe it's like Jesse Livermore line or something. But essentially, the crowd is always right in the middle. And you never want to fight the crowd in the middle of a trend, because they're the ones that are actually providing all the buying to build the trend and drive the trend. But the majority of people are always wrong at the turn, right? Whether at the bottom or the top.
And that's a great point.
Right?
And I gotta start. For me, I struggle with, like, when I get people start agreeing with me, I get uncomfortable. So I got to be comfortable with the middle part, which I'm not. Okay, listen, Walter's got a couple of little additions to his thing here that I think is interesting.
And by the way, when the time comes to buy, you won't want to, works in other directions. When the time comes to sell, you won't want to, because everything will look so good. If you're short, when the time comes to cover, you won't want to, because you will be making money on the short side and things will be looking so bleak, you'll figure this thing's going to go down forever. And a corollary from earlier this year, when the time comes to short, you won't be able to borrow the stock.
I thought that was a good little bit, because that is true. And so, listen, I just want to say one thing. I really feel like I understand the bond bear reasons. Out of all the people that understand and have been highlighting term premium and inflation and all the reasons why to be bearish on bonds, I get it. But I think it's interesting that now, when we're down 55% on the long bond, we've just had 3 years in a row where the returns have gotten killed. People are the most bearish. Yeah. And does that mean it's going to stop here? No, it could go lower without a doubt. But it seems to me that the risk reward on the bond market is completely skewed the other way now.
Yeah.
And that's a lot. You know me.
Yeah.
I've been really
and more importantly, you've been right. Maybe 3 years early, but you were right, pretty much bang on.
but I didn't give up, and I stayed bearish for a long time. And maybe I'm 3 years early on the long side too. Yeah. And I get it. I understand all the bear reasons. You don't need to tell me.
I'm not
I get it. I understand them. And I'm not saying you. I'm saying I'm going to get emails telling me all the reasons, and I get it. I just think that it's interesting now with 10s at 5 or whatever they are, and or 30s at 5, and we have a situation where everyone's absolutely convinced that they're going lower, and yet when we were at 3.5 and 3, it was like recession, bro. Like, that's all I heard. Recession, bro. You don't understand. Recession, bro. And now all I get is like term premium, bro, or supply, bro. Like yeah, I get it. And I'm not saying you're not right for the little while. And maybe we do have to have this washout, because I hear that as well. Like the sentiment has gotten so, feverish on the short side that we need to have a washout. But the thing about bonds that's slightly different is that the people buying them, they don't need to sell them oftentimes. Yes, there are some levered players, but on the whole, a lot of these people are buying bonds and they're just putting them away.
Yeah.
It's different. It's a different asset class. And now all of a sudden, when you were shorting bonds and they were 2 or 2.5, your cost to carry on them were a lot different than now all of a sudden you're shorting them and it's 5. Like, you can just buy money market and
the one thing I want to just highlight, and I think you're going to agree with me, I'm going to assume, but if you are buying bonds here and putting it away, I think the most important thing is to actually buy the bonds and not bond funds that because you want the benefit of being able to hold these things to maturity, and because then you could actually calculate your actually return to maturity. And
yeah, I guess so. But It was funny on the bull market on the way up when everyone was excited about rates going lower. I never heard that argument. Like it's only now because everyone's petrified.
But
about
but
lower
think about it. Let's say you're wrong. Okay, you're trying to catch a falling knife on bonds here, but what if you're wrong? At least if you have, let's say, a 2 or 4 year paper, and you know you're going to get an X return to maturity, and then you don't have to dick around with, what's your exit strategy? We're going to cut out. What are you going to do? Right? Like when you're trying to be a rock star and catching a bottom on something dropping this way, I just think that's a little safety mechanism.
Okay. Anyways, I just think that it's interesting. I really, to me, this doesn't feel that much different than the COVID lows in the stock market. And at that time, no one could imagine stocks ever going up.
Yeah.
And it seems to be that bonds, the pessimism out there is rife. And yeah, I get it. I understand all the reasons why. And in fact, I wrote a whole piece about how even if the economy rolls over and we have a situation where the Fed cuts rate 200-300 basis points, if you look at the curve steepening that happens, a lot of times you might get a situation where the long bond goes nowhere. Because the reality is we need to trade with 300 points of, 2s to 30s or whatever. And that means that you're not going to go anywhere. But the difference is now, though, Patrick, is that in the meantime, you're still getting paid. So someone that owns a 30 and it goes from 5 to 5.25, they lose on the principal amount. But in the meantime, they're still earning the 5. And it used to be at 2 when everyone was bullish, thinking it was going to go to 1.
Yeah.
When you were wrong and it went from 2 to 2.25, it hurt you, and yet you only got paid 2 to wait. So there's a lot to be said about this, and I just think people should think long and hard about it. And plus, this idea that Howard Marks has that we're going to see a situation where people are selling their stocks to go into corporate bonds, that's still taking duration out of the market. They're still buying bonds. Yeah. And I think that's really the decision you should be making, is looking at the equity risk premium. And yeah, you might tell me that bonds are going to go from 5 to 6, and you could be right. But I think that's a lot. Owning bonds from 5 to 6 is a lot less scary than owning stocks up here.
Right.
Because if that does happen, I think that the stocks are going to be a lot more trouble. No. So that's the part that I have is the problem is that everyone's all bearish on bonds, yet there's no problem owning Mag 7 up here at these insane levels. Okay, let's go to the next one here. Nick Colas, it was on with Compound and Friends, I think that's the name of it, with Josh Brown and Michael Batnick. And Nick used to work for Steve Cohen, and I loved all of his. He gives I think he calls them Steve-isms. Let's go. Let's listen.
Right there. Tell us about, quote, "There's always a reason."
Yeah, this is another one.
I agree with this, and I like this one, but I want to hear what you mean by it.
Yeah, this was like if I had to narrow down what I learned working for Steve to one thing, it is that saying, if a stock is going up or down, 1% or more, and the market's flat, there's a reason that's happening. And if it's important to you, you should know that reason. But it's also a time allocation discussion, because you can't know the reason behind 100 stocks. You can know the reason behind maybe 20 stocks.
Okay.
So you got to pick your spots with the time you spend to develop the information edge that you need to trade.
So are you looking at things like relative strength? You want to know how a company's doing relative to the market. If the market's flat and a stock is up a lot over a 6-week period, whatever it is, like that's meaningful information.
That's huge. Like the Apple. Apple falls apart. Biggest stock in the world falls apart 10% in 2 weeks.
Yeah.
You got to think, okay, what is going on?
Well, the reason sometimes becomes apparent after the fact, and then sometimes it never becomes apparent. People in the market knew something. That news never quite got out.
Yep.
Or a stock makes a move, and then we look back at something that happened already, and we say, oh, that's why. And it makes a lot of sense in hindsight.
Yeah.
So this is a very frustrating game to play. This should not be played by people who are not doing this for a living.
It is very hard.
But you know what's funny? Another reason why it's so hard is you might look at a stock that has great relative strength and say, I missed it. Where the answer is, no. It's strong for a reason. Buy it, you idiot.
Patrick, I thought about you there. Not because he called him an idiot. Because I feel like that essentially is the essence of your charting, is that you're not sitting around trying to guess fundamentals and say that this should be doing something. You're listening to what the market tells you. And I thought that was a great
tape reading and seeing flows. Because fundamentals tell you about the management, the quality, the multiple, the growth rates, all of these things which matter over the long term. But people are voting with their money, and whether or not a stock is in a position to perform is all about the element of where people are voting with their money. Where is the flows? Where's the relative strength? Where's the action? You have to be able to observe that, and this is where technical analysis, in my opinion, is a perfect complement to fundamental analysis. I don't want to say one is better or worse than the other, but I think that the two actually complement each other very well.
Okay, now the next one is probably one of my all-time favorite traders ever. And it's not because we share the same hairstyle. I love Mark Fisher. He's in charge of floor traders, and I love the way he thinks. I love the way he talks. I love everything in terms of how, him as a trader. He's one of my idols. I thought this was, again, he was with the Compound guys again, and he had some great insights. Let's listen.
Started working out with Mark. And
Mark looks confused. That's not how he remembers it. Keep going.
Because I didn't work out. I jlub around. And we kind of hit it off, and he invited me down to the floor, and the rest of it's a story, I think, right?
What did you see in Joe that made you think, let me get this guy?
By the way, that's Joe Terranova from CNBC, who I didn't realize actually got his start with Mark trading down on the floor at the NYMEX.
Out of the gym and show him what I do.
So one of the things that I can do is I could tell within 10 minutes if someone can make a trading or not.
Really?
Yeah.
Without even watching them trade, just watching what?
No.
What are you watching?
There's 4 steps to the decision-making process. Collecting data, analyzing, deciding, implementing. If you're good at that 4 steps, right, and you're quick about it, you can make it. For instance, I always tell you the story of I had 2 guys work for me. One guy was a graduate of Harvard Law School, graduated second in his class, and another guy was an ice cream truck driver in Lang Beach. And the ice cream truck driver, I saw 50 kids go up to him and go, I want this, and he would just keep track of everybody and make at the same time. Who ended up making $50 million trading commodities?
The ice cream man.
Ice cream man, not
Okay.
the Harvard trade.
Yeah.
And I saw that Joe had that same process. The difference between a trader and a doctor is if you do this process as a trader and you get good at it, okay, the worst you do is you lose money. If you do this process too fast, it's you kill somebody.
Yeah.
So obviously it's a different thing, but I can recognize people that can actually have that skill set.
So, Patrick, one of the things that I've always thought was interesting is that I had my best friend came from one time, and he sat beside me and he watched me doing my work, and he says, I don't know how you do it. And I said, what do you mean? He goes, well, you're making all these decisions based upon like 50, 60% of the information. And I said, yeah, if I wait around for like the 100% of the information, I'm going to be like, it'll be already in the market. And for him, he found that very disconcerting. Like he didn't like it. And yet I was impatient, and I was like, no, I'd rather just like, I'm close enough. Let's make the bet.
Look, in the markets, it's always about probabilities. There's no sure things unless you have insider information. And even then,
it's not sure.
Even that, exactly. Still, things can go wrong, and so what we're seeking to do always is to build some sort of asymmetry in the trades, where you can go through the process and be wrong a number of times, but make more on all your winning trades that outdoes the losers. You can't. You have to always played on probabilities, and the problem is that a lot of people can't function in that world. They want the certainty, like an engineer that says that this amount of concrete and this amount of steel rods will hold this bridge and carry this kind of weight and survive this kind of earthquake. It's all just math. They're building a bridge that isn't going to collapse, right? This idea that, well, there's a 50% chance it might collapse. It's like they can't deal with that, right?
I don't want to be on your bridge.
No, you don't. But you know what I mean, right? Like it's.
Yeah, no, completely get it. Let's now listen. The rest of this, don't forget, Mark talks about traders, and it's a very specific trader. So, a trader down on the floor, which might be a lot different than a portfolio manager or an investor or a trader that trades their long term. But it's helpful to listen to how he kind of thinks about them.
And that skill set is the most important thing to do. To be
so, I mean, it sounds like it boils down to like, I don't want to say the word hustle because that cheapens it.
No.
But it sounds like somebody who is. It's almost like hand-eye coordination, but keeping organized mentally and remembering things that just happened 2 seconds ago and doing things in the right order.
I like to say, are you the point guard or are you the power forward? The power forward is not making a trading. The point guard is.
But what about personality? Because a lot of this game is mental. Obviously, you need to be able to think and analyze, but sometimes you're your own worst enemy.
Everyone's their own worst enemy.
So, Patrick, I especially like this because I have this theory that I always say that making money is easy, keeping it is actually really difficult, and that eventually people start out thinking that they're battling the markets, and after you do this long enough, you realize you're battling yourself. And Mark shares that thought.
Yeah.
That's the whole thing. You know, you see a guy every Monday morning come in. We used to have people come in Monday, first morning, and lose money every Monday morning. And then I would go to him, when are you getting divorced? It's all about how well you can manage yourself and how well you can manage, your life. And you hear about it, but if the hardest thing for a trader to do is risk manage himself. That's why, for myself, when I trade, I don't execute myself. I have someone execute for me. Otherwise, I'd be like this all day.
Well, what does risk management mean? Like to you?
To me?
Yeah.
Number one, making sure, where am I getting out if I'm wrong? If I have no idea where I'm getting out, I'm not getting in. Okay. Why am I making the trade? Right. What's the probability of success? Right. How many trades am I making just because I'm bored versus how many trades I'm making because of the real trades? Right. Is everyone else thinking the same way I am? If everyone else is thinking the same way, I'm not doing it.
It sounds like it requires a lot of self-awareness, and you almost have to psychoanalyze your own actions during the course of the day.
Yeah.
To catch yourself and say, wait, why am I doing this trade?
Right.
How many years can you do that before either you figure out, okay, I do belong doing this, or it drives you crazy? It would seem like most people are not cut out for that level of self-reflection every day, but it's required because you're taking risk.
The problem is that with traders, I could usually tell within 6 months whether someone's made an effort, but the problem is that things happen. They get married. Was it the right person? Then they have a child, that whole thing. Then they buy a house. Then someone significant to them, a father, mother passes away, or there's another thing. All these different things impact them in a lot of ways. They won't tell you, that a dog dies. Weird things happen, and it affects people in the way they operate. I can't tell you how many people I've been to that traded with me that I've been to the psychiatrist.
So, Patrick, when are we going for our joint session?
We need one. We should just bring one on the show and we can.
That's right. We could have anyways, I thought that was really, we're running late here, so I'm going to let it go. But I thought Mark had some great points there. And I really, really believe that you are your own worst enemy in trading, and that the hardest part is actually
always
making
is.
sure you
and this
control yourself. And I know that's something you focus on, and you always say that the thing you like about being long options is that you're limiting your risk, and you know what you're going to make and lose each times ahead of time.
Right. But it's also about developing a more systematic way to approach your investing and trading, because if you do too many things intuitively, then a lot of the way that the mood, the way you woke up in the morning influences how you trade. You have to have a way that you're systematically doing it, so your emotions and your mental state have less of a role to play than they normally do.
Right. All right. Let's go on to the next segment.
What is this common sense with Kev segment that you're adding in here, bud?
Well, it's one of my rants, and I just have to get it off my chest. So let's go on to the quote here. And I saw this kind of thought, and I read this, and I can't remember exactly where it was. It was some, FinTwit star or something. It said, levered hedge funds have been one of the biggest marginal buyers of USTs, which is U.S. Treasuries, in recent months as part of the relative value basis trade. Last month, a senior executive at one of the world's largest HFs, hedge funds, told FT, if hedge funds stop buying USTs, I don't know who would buy them. Okay? So the problem with this is it's kind of, first of all, it's going back to my thought about this doom at 11 narrative on bonds. It's like, oh no, if they don't buy them, what's going to happen? And not only that, like, how much can the hedge funds buy? And one of the things that I just want to highlight here is that I remember 6 months ago when everyone was long USTs and they were highlighting the kind of treasury complex, the number of speculative traders that were actually short the futures. And they were like, oh, this is why you have to buy treasuries, because the reality is all these hedge funds are short treasuries. Okay. And I was always like, no, that's not right. This is the basis trade. It's different. It doesn't really mean what you think it means. Stop looking at this. Just stop it. Like that Michael Jordan video on drugs. Like, just stop it. Don't do it. And yet it just continued and continued and continued. And now we're actually getting the opposite. We're getting the people saying, well, if the hedge funds stop buying the cash bonds, look what happens. There's going to be no buyers for the treasuries at all, and that's why it's going to go lower. Well, so you're going to use the kind of this boogeyman of the hedge funds when you want to think it was going to go up, and you're going to use the boogeyman of the hedge funds when you think it's going to go down. The reality is that the hedge funds they've been a conduit, and they've been a conduit for funds like PIMCO and pension funds and all those other funds that actually use futures to change the duration in their portfolios. So yes, the hedge funds are buying cash bonds, but they are selling those they are selling futures on the other side of that trade to those end buyers. And those end buyers are really the people that you should be worried about not buying any more treasuries. Because the hedge funds aren't going away. The hedge funds are standing in the middle because the end buyers would rather have futures than the cash bonds. So what happens is they buy the futures and the hedge funds sell them to them, and then they buy the cash bonds, and they do that ARB. And I know there's some increasing concern about the size of that position, but and there is some funding risk. So it's not like it's completely and utterly riskless, but on the whole, it's actually a positive trade in that there's optionality. Usually it's actually the way it's set up. The hedge funds have the optionality. So if the yield curve shifts, they're going to make more money because they might have a different cheapest to deliver. So I just want to kind of highlight that. Stop using these arguments as this boogeyman that, that there's going to be some calamitous event because if the hedge funds stop buying or the hedge funds are short all these futures. This is just how the market works. This is the hedge funds are intermediaries on the futures versus the cash, and that's all. And there's right. Yes, the position is as big as it's been in a long time, but there's a lot of treasuries out there as well. Anyways, rant over. It's not what they think it is.
All right. So this is where we're going to get Lena involved and do our No Stupid Question segment. Hey, Lena.
Hello.
All right. So what's the first question?
The first question here. Hi, guys. Historically, oil prices were inversely related to the US dollar, supposedly because importers paid in US dollar, and if the dollar dropped, they could buy more for the same dollar. The last few years, though, it seems this has reversed, and oil and the dollar are correlated so strong. Dollar strong oil. Wondering about your thoughts on why this change and what if anything might flip it back to being inversely correlated. Thanks, love the podcast and find it very useful. Brian from Burlington.
So Kev, like what I'll just start and then you can kind of add your thing in there. Obviously, any commodity that's priced in US dollars is going to be influenced by the movement of US dollars. So he's referring to the natural correlation, inverse correlation of commodities to the US dollar. But the one thing is that we've seen in the past, like even in 2007, 2008, where the dollar and oil would move together. Oil is such a huge market. It's like something like $2 trillion market. And it's so huge that it drives recessions or economic cycles, let's say. And so like deflationary cycles, inflationary cycles. And so it's so big that there are periods where it's not just going to be influenced by currency. There's a point where it is actually the driver of the cycle. Is that, what would you add to that?
Well, and I'd like to add to that is that don't forget that the U.S. used to be a huge importer of oil. And so that when the oil price went up, it would affect their balanced trade, and there would be a lot of issues that way. They're now I think they started to be an exporter, and so they're oil self-sufficient at the very least, and it's completely changed the ball game in terms of that equation that used to be. So I think it's ever since the shale we've seen more and more U.S. production, and that changed the equation with the dollar and
Yeah, I think it's much easier.
Question.
It's much
sorry.
easier to track, for instance, dollar correlation to, let's say, the Bloomberg Commodity Index, where you basket everything and you're looking at the general level, as opposed to individual commodities, which sometimes have their own supply demand input variables that have them decouple from this correlation over intermediate periods of time. Anyway, Lena, what's the next question?
Second question here. Dear Huddlers, I have my portfolio in US dollar and live in Europe. I want to hedge the exchange rate with Euro USD currency options. It looks cheaper than futures and leveraged ETFs like ULE. I want to do it for 1 year. Do you know what is the most cost-effective option to buy? Thanks in advance.
All right. Well, Kev, let me start off, and then you can again add to it. Well, the one thing I'd highlight is that when you're buying futures or leveraged ETFs, you're almost flattening the position. That's a little different than hedging. Hedging is buying something that's like an insurance policy that will blunt the losses that you're incurring for being on the wrong side of the trade. And so I think that it's a very, very different trade using options versus taking inverse positions in futures or ETFs. In the same way, when asking the question of a cost-effective option, well, I mean, options are all priced at a certain implied and probabilities matter. So the question is what are you trying to hedge? Are you trying to hedge a currency move greater than 10%, or are you trying to remove all risk of loss if you're wrong? I mean, there's different costs associated, but you have to first start with understanding what is the risk. What are you trying to hedge? What is the real kind of worst case? And then you go backwards, and well, if this happened and it would be devastating to the portfolio, then I have to construct an options trade that will be able to build gamma on the tail if that move started happening.
Yeah, and it's also more complicated, and we're not giving advice here. Like this listener should definitely go talk to an investment advisor. But one of the things that I will highlight for people that are actually looking, at hedging a portfolio, you also don't know the value of that portfolio. So let's just say you have your European, you own, U.S. stocks, and you want to hedge it, but don't forget the P&L on that portfolio is changing. So it's actually a dynamic hedge that you have to do. So it's a complicated way to do it. In general, I will say this, that futures and futures on options are one of the more cost-effective ways to do. So I would go learn about those and figure out what you want to achieve in terms of your payoff profiles Patrick mentioned, and make some decisions from there.
All right. Next question.
Yep.
Hi, crew. What tools do Patrick and Kevin use to monitor the markets, if it's not a secret? And what is the last time they adopted or dropped a tool? Thanks. Love your shows.
That's a great question. I like this one.
You want to start?
Can you go first, Patrick?
Well, I don't necessarily use a tool. I mean, my approach is far more macro, top down, and looking at the intermarket relationships of the whole market.
I think they're asking. Wait 1 second. If I'm not mistaken, I think they're asking what trading platforms you use and stuff.
Well, monitoring the markets, right? So okay.
Am I wrong? Let's answer that, because that's how I interpreted it.
Okay.
So what systems do you use to monitor the market?
Well, I mean, I'm predominantly doing my charting through TradingView. So to me, it's about the technical analysis of the macro markets using that. So obviously, I look at it online for a number of news feeds. I don't really use a Bloomberg the way you do. I mean, you crutch on that Bloomberg, don't you?
I am a little bit of an embarrassed Bloomberg user, but so what else do you use? You use IB? What do you use for your option pricing and stuff? You have your own on your website. Is that
yeah, exactly. We have I definitely have different spreadsheets and things like that for option pricing and modeling portfolios, and particularly a lot of what if scenarios in terms of how the positions would change under different circumstances in the markets. How about
And
you?
for me, I use the Bloomberg. Obviously, that's my favorite one. I guess if I wasn't to use the Bloomberg, I must admit Patrick's Trading Views produces some good looking charts. It's tough to argue that for online stuff that's not one of the better ones. I also like using some scanners and some trading systems. I love TradeStation. I know it's weird. I've always liked it. I like their easy language. I write some programs in there. I like it on the app. I think it's great. On my trading apps, I use IB is one of them. I obviously have some other brokers and stuff like that. And then I have a few tools that I've written, or not I've written, but one of the guys that I used to work with wrote for us. And we so have some proprietary trading tools where we talk directly through APIs to different brokers. All right. Next question.
All right, next question. Patrick and Kevin, pros often discuss the concept of a big player, quote unquote, bullying or manipulating the tape. How do they do this? And what are some signs to look for that this is occurring? Thank you.
Can I take this one, Patrick?
Yeah, please.
Okay. So this does happen. There's no doubt about it. And I'm trying to think about how I would actually describe it. Sometimes they'll do it because they're trying to accomplish something, like move something somewhere. So, for example, let's say that they were buying a stock for the last week, like it's one of the big pension plans, or generally it's not a pension plan because they're not as aggressive and they would have more controls. But let's say it's a big hedge fund. They've been buying a stock for a week and the order's wrapping up and they just want to make sure it looks good for like when the finish is, when they finish it. So they might save more of the stock to buy or sell towards the end. There's like a line. It's like what they'll say to their broker, buy it ugly or sell it ugly. And what that means is don't try to get me the best price, try to move it the most. And I know that's technically illegal. I don't know if guys are so blatant about it, but you'll see it. And what it'll be is it's just kind of when you're looking for that sort of move, you'll see a big, not like a sharp movement that doesn't really have any explanation, that doesn't seem to be as price sensitive, or not price sensitive. It doesn't are trying to get the best price that they can. And it's more like just get it done. And so that's what I would argue bullying or manipulating the tape looks like.
All right. And Lena, the last one?
Last one here. Time to kick Patrick off the island. I just finished listening to the show that Patrick cheats on Kevin. I've never heard such unadulterated doom content in my life, with the guest suggesting that the U.S. was inevitably going to become Argentina. OMG. And Patrick was all in. My question is, when is it appropriate to put these doomers on a holiday? Should Patrick be voted off the island? Love the pod. Keep up the good work.
I can't believe you guys included that.
So
just so you know, and it should be obvious by my answers, I do not know the questions that they're going to pick. And so... Who picked that, Lena or Patrick?
Why was it me?
I put it. So listen, I've been voted off the island numerous times, but I find a way back on the island every time. So you can try to kick me off. He
swims back.
I swim back. It's there's no getting me off. You can make me walk a plank and everything, and so I always somehow end up back on the island. Yeah.
Well, that's good. I obviously missed that one, but you know what the trouble is? I'd go look and try to find out which one he's talking about, which episode, but I'm pretty sure they all sound like that.
I don't know whether it was Luke Roman or whether it was
doesn't matter.
Or it could have been Alex Gravich. I don't know.
Yeah, they all basically end with that. Right. Okay, so now we need to talk about the last little thing. Lena, tell people where they can send their questions.
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Okay, right. So now we got to talk about my embarrassing loss. Right. And I have to take people out, which I'm excited about, to dinner. And we've decided on the date. And this is, of course, we're talking about skin in the game, how Patrick beat me. Fair and square. There's no way that he altered those rules to make them better for himself.
No. I would never.
So it's Tuesday, December 19th, and it'll be in Toronto. So if you're going to be available for then, you can submit. And Lena, where are they going to submit? What's going to be the email?
The email address will be winner@markethuddle.com.
Oh, okay. And
I
what
like
you
that.
need to do, winner, to be eligible is you need to give us your favorite quote from a Market Huddle episode. And I'm assuming like it can be from Patrick or I, but we prefer it to be from our guests. And it's a favorite piece of wisdom or a favorite actual quote. And so you have to tell us what episode it is. We prefer a timestamp. And so like if you really love like Jimmy Jude saying this, like go say episode 75 right here and give us the line and that, and we will, with all those people that send them in, we will choose 3 people and we will go out and have a great time. I've already picked the craft beer place we're going to go. We're going to go drink some beers and talk about markets and talk about how Patrick's a hoser. So again,
what are you talking about? I'm no hoser.
So to be eligible, it's December 19th. You have to be in Toronto on December 19th or willing to come. I don't care if you're here, like just as long as you're willing to come for December 19th. And it's send the email to winner@markethuddle.com, not the Market Huddle, just markethuddle.com. And we need to include your favorite quote / piece of wisdom with the episode and the timestamp. Hopefully, we'd prefer that of an episode, and we will pick 3 of them. And the deadline, we're going to make the deadline cut off November 3rd, 2 Fridays from now, and then we will announce the winners a month from now at the following show.
Nice.
If I got it, Lena?
Yeah, I think so.
Okay.
And
all right. And
you
know what?
Show.
I won't be here next week, or the next couple of weeks. But Patrick will be, and he'll remind you. Oh no, he won't. Bill will remind you because the reality is it'll all be over. So make sure you do that. You know what?
And
Maybe
you
we'll
have 2
tweet
weeks.
it out as well.
Yeah,
you got 2 weeks to pick your favorite quote and send it in. December 19th. Looking forward to it.
All right.
Okay.
Take us to the close, buddy.
All right. I wish I had the thing up. You guys know the drill. We enjoyed.
It was a great episode. Yeah, it's awesome.
Yeah, you guys know the drill. Patrick, where can they find you?
You can find me on Twitter @Patrick Ceresna or follow me at bigpicturetrading.com. Where can they follow you, bud?
You can go to themacrotourist.com or you can check out themacrotourist.com/chat. Anyone can come. We're always willing to have new folks join our group. It's lots of fun. And listen, we can never have too many friends on this ride, bull market, bear market. We just appreciate you spending some time with us. Now stick around for the after show.
All right.
I lost my script there. Okay.
You weren't
Surprised you don't remember it.
So let me rate the beer here.
Oh, yeah. Do your rating.
You know what? It's a good beer. I'm not going to give it anything special. I was drinking it too slow, so I drank the second half kind of warm. And that kind of ruined it. And that kind of ruined it for me. I'm going to give it a
user error.
Yeah, user. I'm going to give it a 7. 7.3.
Enough beers.
No, clearly. 7.3.
What? 7.3.
7.3.
Another mopey score. I'd expect nothing less from you. Okay. What should we chat about? Anyone see anything good?
I don't know. Were you the one that told me about Pinball, the man who saved the game, or whatever?
No.
So there is this movie. It's in like a mockumentary style, but it's basically about the story how pinball was banned in I don't know if it was all over United States or if it's certain states. Definitely in New York, and it's about a guy that saved pinball games. So it's no longer illegal.
What? And is it like Spinal Tap?
No, I wouldn't say it's like Spinal Tap, but it's definitely worth checking out.
Oh yeah. Okay, let's see how many tomatoes I got.
I think you'd like it.
Rotten Tomatoes. Okay, pinball. I've never heard of this. Like, it's pretty cool. It's interesting. I am watching The Night Manager.
Night
It's
Manager.
a John le Carre thing. It's actually pretty good. I liked it. I'm just a couple in. Oh, and then my wife's got me watching because it just came up. The what's this one? What's it called? The one with Brie Larson. Lessons in Chemistry.
Oh, I haven't.
Yeah, Patrick, that's no good for you.
No.
But
Patrick has no idea.
yeah.
No idea.
It's October, so I started watching horror movies.
Really?
Yeah, I watched The Departed. Any
92
movie that Leo
tomatoes for the pinball.
Any movie that Leo dies is a horror movie for me.
Oh. Depart. Is that the one where the grizzly gets him?
No, that's The Revenant.
Oh, because that one's more appropriate.
The bear gets him.
Oh gosh, I was watching this video on YouTube because I was looking up something on bears or something, and now you know how when you look something up, it just kind of keeps serving you things. And I saw this video where
Was it a video of Patrick?
No. These people were like on, I think it was Glacier Park in Canada, you know, in Alberta, and someone was filming it from way away, and there was this bear running, like kind of following them, like a big grizzly, and the people are screaming, "Don't run, don't run!" And the people are like, you can hear the people yelling at the bear, and then all of a sudden you just see them scatter everywhere.
Oh,
and they're running,
gosh.
and I'm just like, they're fine. The bear did not chase them, but it was pretty funny because like, he's sitting there like,
dangerous.
Don't run, and then all of a sudden everyone, the fear takes over, and they're
like, nope, gonna run.
So, no, it's at least you have a chance. Like it's the slowest runner that's screwed, right? Like at least if you think you can outrun.
But if you stay together, you're going to be better off, and you just.
Well, this is why.
And so they scatter.
You gotta stay fit.
They scatter.
That's why you gotta work out every day.
This is why I'm not going hiking with Patrick. Fuck it, I'm out. I'm just gonna run. I've seen you, Kev. You don't work out very much. I'm faster than you. You're done, buddy.
You're done. I'll come back with help.
You know what? I'm going to cut this one short. I actually got something on tonight. So listen, it's great having everyone. I'll see you in a month's time.
Yeah.
And we'll have some MH pluses in the meantime. But thank you for tuning in, everyone. We'll see you in a little bit.
All right. Thanks, everyone.
Okay, bye-bye.